Welcome back to the channel. It's Matthew Decker with my associate Brady Watkins. If you're new to the channel, we specialize in life insurance and annuities and financial planning. And today we're starting the first in a series of annuity video reviews. Now, a couple weeks ago, we rolled out the Annuities 101, which was a big, large grid that had a bunch of different quadrants on there. And we told you that we were going to be doing annuity reviews for all the products in those different quadrants because there's different products for different goals for all kinds of different people. And so, Brady, why don't you tell us which product we're focusing on today? And while you're doing that, we'll throw that grid up on the screen so you can see where it fits in.
So we are talking about a North American Prime Path Pro product.
Say that again.
Prime Path Pro product. Prime Path Pro product.
10.
And so this falls under the silo of performance-based income, kind of with an emphasis on a deferral product. So that's what we're going to be talking about today.
Well, we've got a Prime Path Pro 10 product here on the screen that we'll be flashing back and forth to as we kind of walk through just some of the key provisions in these contracts. And these provisions are the same provisions that we're going to run through for every annuity review that we do kind of from here on out. So Brady, why don't you start us off with the first thing on our list, tell the good people what it is, and then we'll find it here in the illustration and chat about it.
Absolutely. So the first thing that we're going to talk about is the surrender schedule. And just a hint, usually with the products, if they have a number at the end, it's going to be the same as the surrender schedule. So this is a 10-year product. They also have a 12-year product, but we're going to be looking in on the 10-year. Before 10 years, if you wanted to surrender the policy, there would be a penalty.
And it looks like that penalty is line itemed out here in the illustration, 10% for years 1, 2, 3, 4, and 5. So it's a 10% penalty if you cancel the product or if you withdraw more than what the free withdrawal provision would be. There'd be a 10% penalty for the first 5 years, and then it drops by 1% for every year after, 9, 8, 7, 6, and then it goes down 2% to 4 in the last year. And after those 10 years, you're what? You're free and clear?
Free and clear.
Free and clear. Okay. So that's a pretty standard surrender schedule for a 10-year annuity, I would say.
Next, we're going to talk about penalty-free withdrawals.
All right, which is easy because it's just under surrender charges here on the illustration. So I'll read it for us. That way we can all follow along. Once per year after the first contract anniversary, you may take a penalty-free withdrawal without surrender charges or MVA up to 7% of your beginning of year accumulation value on IRS required minimum distributions exceeding the available penalty-free allowance, surrender charges, and MVA, but will be waived by current company practice. Okay, so Brady, what does all that mean?
Yeah, so penalty-free withdrawals are essentially what can you take from the annuity for free. So there are surrender charges, but you have the ability to take 7% out of this annuity for free after the first contract year.
And it looks like that's based on the beginning of year accumulation value, which means every single year, the amount of penalty-free withdrawal that you have is going to change. Because if you take money out, it's based on the starting value of your accumulation account, which is different from other products in the industry where some products will give you a penalty-free withdrawal that's simply based on your initial premium, and it stays that way for the life of the contract. This one's a little bit different. It's based on your accumulation value of the previous year or the start of the year for your anniversary.
And I'd also say this can change. So not every product has 7% as kind of the ordinary number. So that could be higher, that could be lower. And so that's something to consider as you're looking at an annuity for various reasons.
A lot of companies have a 10% free withdrawal. This one being 7, a little bit lower. Okay, great. So far, so good. What's next on our list?
So next we're talking about, are there any fees on this annuity product? And so the answer to that is no, there are no rider fees on the product. However, if you want to take a little bit more risk on certain index allocations or choices, you can pay extra strategy charge in order to kind of get a higher participation rate if you would like. You have the choice to do that. However, there are no rider fees on the product.
So that's a pretty nuanced answer. Let's try to break it down. We just went through the surrender charges. So technically, a surrender charge would be a fee, but only if you cancel. Okay. The most common form of a fee on an annuity would be what you just mentioned, a rider charge. And so let's look at the ledger real quick and we'll just show you what Brady's talking about here. So we're looking at the guaranteed ledger, and this has $100,000 going in. And you can see our accumulation value here is $100,000 in all years, showing a 0% credit. So if there were rider charges or fees on this particular product in a environment where you're getting a 0% rate of return every year, your accumulation value would not hold at $100,000 for all of these years. You'd see it drop by the fee. So that's what you're pointing out. There's no year by year rider charges on the product. Did I get it right?
Yes.
Now you made a point to tell us that there's potentially a fee on the index accounts.
Yep.
Can we go there next and just have a quick conversation about that?
Let's do it. To overarch some of the index allocations, and a lot of carriers do this, there are essentially 3 different options, and then they kind of split up those options with different types of benefits, maybe a high participation rate, maybe a cap focused. And so there are essentially 3 options that you can do as the underlying index. So the first one would be the Morgan S Dynamic Global Index. The second would be an S&P base, which most carriers have that. And then the third would be the Multi-Asset Risk Control 5% ER Index. And so that is Mark 5. And so all of these play a little bit different role in the product and give you kind of a slice of a different flavor if you want to kind of diversify.
And it looks like we're using the MSDG, the Morgan Stanley Dynamic Global Index. Which of the index allocations has the potential fee? Is it all of them? Is it just one of them?
It is the 2 volatility controlled indexes, which would exclude the S&P.
Okay. So the non-S&P indexes, you say, do you get to choose to pay a fee?
You do.
Okay. So it's not that they can impose a fee on you. It's that if you would like to take additional risk, you can elect to pay a fee and hopefully maybe get some juice in return. Is that what's happening?
Yeah, the juice is essentially a higher participation rate. You can choose those 2 indexes outside of the fee if you'd like, but like I said, if you want to take more risk, you get a higher participation rate, then it's there for you to kind of get that extra juice.
So let's summarize it. There are no fees on this particular annuity unless you surrender during the surrender period. But that's not necessarily a fee, that's a surrender charge. There are no fees on this annuity unless you elect to pay more in fees in order to get something in return. But North American as a company is not going to impose a fee on you without you knowing about it. Did I get that right?
That's right.
Perfect. Okay, and we'll flash, you can kind of see in this illustration, since we're just using the one index, Morgan Stanley, we don't see all the options here. So we'll flash all those options on the screen so you can get a feel for what's available and what the fee would look like. All right, so Brady, I think the next thing on our list is the actual income rider. And this is a little bit complex for an income rider. So hang with us. There's 2 parts to this income rider. Can we start, Brady, with the benefit base? What is it? How does it work? Why should people care about the benefit base on this product?
So the benefit base is essentially a separate column from your accumulation value. And what this is doing is keeping track of whenever you start the income, that is the amount you're going to be looking at in terms of the amount of money that is there. And North American or the carrier is going to be giving that or treating that differently than your just straight accumulation value.
So there's 2 values. There's a benefit base and there's an accumulation value. The benefit base is the number that is going to generate the income. Can I cancel and take my benefit base out?
You cannot.
Okay, so the benefit base is what we would refer to as a phantom value. It's not a value that you actually have access to. It's simply a value that's going to take part in the equation that determines your income. And okay, so tell us how the benefit base works. It looks like they maybe juice your returns here so while you defer.
So they calculate the benefit base. Essentially, they take whatever your policy has performed at for that year and they multiply that by 200% for that year. And so, for example, if you got a 4% on the index that you were in, the benefit base would go up by 8%.
So your phantom account goes up by twice the return of the underlying index that you've chosen. But that benefit base that goes up twice the return is not accessible. It's simply there to take part in the math equation that determines your income.
Exactly.
And it looks like this benefit-based kind of bonus, this 200% bonus, it's going to last for 15 years, which is why it's in the deferral section of this particular product grid. A 15-year juicing of your benefit base is a pretty long time frame to be able to defer and get this this extra 200% bonus. Okay, well, I keep saying this weird sentence about it takes part in the equation that determines your income. So that brings us to part 2 of the rider. How do we actually determine the income? We know there's this benefit base that's going to take part. What's the other variable in the equation?
Right. So let's talk about kind of how the payout works. You essentially have 2 options based on essentially what it comes down to is your risk tolerance. And so the first option is called level. They call it a level payout or a lifetime payout amount. And so what this is a guaranteed stream of income once that 15-year period ends. And so that's not guaranteed from the start. That's guaranteed based on how your policy or annuity product has performed, to that 15-year mark. And so once that locks in, you can get a guaranteed stream of income. That's going to start at a higher amount than the increasing option, which is the second option. The increasing option is going to start at a lower amount. However, every single year moving forward, your income amount is going to increase by how the policy has performed that year. And so if you're at $10,000 a month and your policy goes up 15% for that year, your income is going to go up 15% for that year, over and above every single year. And so this kind of is the ability to outpace inflation with your annuity product. However, you start at a lower point than that level option.
Let's make it a little bit more simple. Let's make it a little more simple and let's break down the components. You mentioned that the income starts in year 16 after the 15 years of deferral. Do you have to wait 15 years to turn on your income?
You do not.
Okay, so you have the option to turn it on earlier, but if you choose to take advantage of the full 15 years of the 200% benefit base increase, obviously then you'd start your income in year 16. So that's what we're showing on this illustration, 15 years of deferral. Okay, so you don't have to wait the full 15 years. But certainly if you wait longer than 15 years, you lose the 200% roll up. So not much of a benefit to not start the income after 15 years because you lose the rider. I think that makes sense. And then you mentioned this level versus increasing. And so if I were to try to just make this super simple, if you choose a level payout, your income is level forever. Is that right? It's never going to change. You started at 30,000, it's going to be 30,000 forever, guaranteed as long as you live. It's never going to go away, it's never going to go up, it's never going to go down. It's 30,000 forever, which means you're going to get eaten away by inflation, which was your point about the increasing. But let's not go there yet. Since you are electing a level payout and it never changes, I think you said this, your payout percentages are higher than if you would choose the increasing payout. And we can show that here on the screen. Your level payout is always higher given the same age as your increasing payout. And then talking about the increasing payout, you start off at a lower guaranteed income, but then every time there's a credit on the policy, your income increases. And how much does it increase by?
The amounts that your policy essentially performed at for that year.
So if I get a 10% credit on my index, my income is going to get a 10% pay raise. Is that
right? And the beautiful thing about these products is they are indexed products, which means a 0% is the lowest that you can go. So on these increasing payouts, you're never going backwards.
So once I get an increase, that increase is locked in. So if I start at 30,000 and I get a 10% increase, 10% of 30,000 is 3,000. My income's now 33,000. And if I never get another return for the rest of the policy life, my income stays at 33,000. If I get an increase later on into the policy, if I get another 10% increase, my 33 is now going to increase by another 10%, and it's going to be locked in at that level forever until I get my next increase. Okay, cool. One thing to point out that I do like about this product and the way they do their lifetime payment percentage is you get a pay raise every year you mature. That's a weird way to say that. Every year you get 1 year older. That's how life works for all of us. And as we all get 1 year older, your payment percentage goes up. It looks like it's going up by 10 basis points per year. A lot of companies will block people into ages where between the ages of 55 and 65, your payout percentage is flat. But then once you hit 66, it bumps up. This one gives you a pay raise every year you get 1 year older. Now that only counts if you haven't turned your income on yet. So the longer you wait, that payout percentage creeps up every single year by 10 basis points. It also looks like on this policy, there's the ability to do a joint payout. And it says here, the asterisk, there's a 50 basis point reduction to the schedule for joint covered persons. So pretty easy if you are married and you want to attach your spouse to this particular contract. The income will pay out for as long as one of you is living. So it'll probably pay out longer unless both of you die at the exact same time. If it's a joint payout, it's going to pay out longer because it pays out as long as just one of you's living. But in order to elect that joint payout, it looks like this schedule of payout percentages is just a flat reduction of 50 basis points in all years. So our 3.5 would just be a 3% payout. Our 5% payout here would be a 4.5% payout, and so on and so forth. It's the same reduction for level versus increasing at every age. Pretty simple stuff. But I like that this is a good payout grid here. What's next, Brady?
So the next thing that I want to talk about is the death benefit. What kind of options do your beneficiaries have, once you pass away? And so you essentially have two options. Beneficiaries can elect to take a lump sum of the accumulation value. So if they want, a one-time payout from the carrier, that will be based on the accumulation value. And the other option is more of a stretched out option. It's 5 years of the benefit base. So that benefit base depends on where they're at, what age they're at.
So it looks like pretty simple. We're looking at the non-guaranteed values here. Again, putting in $100,000, we go down 14 years. Our accumulation value is at $317,000. So if this person were to pass away, young, 73 to 74, they could take $317 as a lump sum, which makes sense. That's a one-time payment of $317, and then it's all gone. It's done. That's it. Or they could take their death benefit base, which in this case looks to be $900,000. They could take that $900,000 over 5 years, and so our 5-year payout would be $180. So you get the choice: a lump sum of accumulation value, which in this example is $317, or 5 payments of $180, which is obviously quite a bit more when you add it all up. One thing about death benefits on annuities is that they are taxable if you take out more than you pay in. If it's a non-qualified contract, if it's a qualified contract, it's going to be taxable all the way out. So hopefully that helps. If you're in that decision-making process, just know that death benefits on annuities are almost always taxable, and that's good to know. All right, Brady, what's next?
All right, the last two things that I wanted to talk about is two things that I thought were really cool on the product and beneficial kind of as you're looking into shopping around for these. So the first thing is there is an ADL rider, which essentially is an activities of daily living rider, which would be an early access rider of sorts, which essentially means if you're unable to do 2 of the 6 daily living activities, you can access this product early, kind of depending on how the policy is performed, and that will go on, through the life of the policy. So you can access your policy dollars early if you essentially have some type of chronic illness. And so I thought that was a huge benefit. The other really cool part about this product is it is essentially a flexible premium annuity. Typically with these annuity products, there is a time span that you can put dollars in, whether that's a year, 18 months, 2 years. With this product, you can put in dollars into perpetuity. So as long as the policy or annuity product is there, you can put dollars in and allow it to grow. So you don't have to make the decision now of putting all your dollars in. If you wanted to keep adding away into the product, that is available for you.
And it looks like this LPA multiplier essentially is going to double your income, is what it's looking like here. It's going to double your income for as long as your benefit base is positive. Once your benefit base hits a $0 value, like it does here, your LPA multiplier goes away and you would revert back to the lower income level. Let's dive a little deeper on this ADL LPA multiplier because it's not super intuitive, but I do think the ledger actually helps us understand. What I want to take away from this piece of the illustration is cannot perform 2 of the 6 activities of daily living. That's a very common long-term care qualifier. 2 of the 6 ADLs, which would be toileting. Let's see if I can do this. Toileting,
refreshing,
bathing, eating, moving, money management, I believe, and then severe cognitive impairment.
Yep.
I think those are the
close.
6.
It's close if it's not right on the money.
Yeah, I think those are the 6. So 2 of the 6, and I think that severe cognitive impairment might be a catch-all. If it's severe cognitive impairment, that's a 1 or 2 of the others. You might want to check me on that though. So if we go to the ledger, they do a nice job here of giving us this LPA multiplier. So we have our normal lifetime payout amount. In this case, this is based on assumed interest back from 2012 until the end of 2022. And so it's showing a $63,000 payout based on this $100,000. That's a pretty rosy picture, just FYI, it's a pretty rosy picture. But if you cannot perform 2 of the 6 activities of daily living, we're looking at this LPA multiplier. So if we start our income at 16 here, year 16, we get maybe another year into it, and we can't perform 2 of the 6 activities of daily living, we can turn on this LPA multiplier, which looks like it's going to double our income. So it's going to double our income, and it looks like it's going to double our income. Let's go back to the wording here. Payments under this benefit may not exceed 5 years. All right, so we can double it for no more than 5 years. And payments under this benefit will not be available if the full LPA is not withdrawn within a full contract year. Okay, so we have to withdraw the full LPA. And then this benefit is not available after the accumulation value has been depleted. Okay, so those are 3 really good qualifying statements there. You can double your income as long as your accumulation value has not been depleted. You can't take more than 5 payments, and it's not going to be available if you don't take the full LPA within a full contract year. So it'll double your income, it looks like, if you can't perform 2 of the 6 activities of daily living for some period of time. Probably your accumulation value is going to zero out before 5 years of payments. So that's probably how it's going to end up working. You probably won't get 5 years of the doubling. You will get it until your accumulation value zeroes out, and then your payment will get cut back in half to the slated amount, $63,311 in this particular case. So a pretty good rider. Especially if maybe you can't qualify for long-term care. This would be a nice way to get some type of a long-term care type benefit without having to go through underwriting, because this is an annuity and there's no underwriting. So a pretty nice little piece of the puzzle there.
Yep. And we didn't touch on the carrier itself. North American as a carrier is rock solid. They have a A rating, A+ rating. I think they're a 92 Comdex score or something like that. And so they're very trustworthy, financially stable, and they do a lot of things really well. So North American, great company.
So good company, no rider fees, really long deferral period with that 200% benefit base. There's a death benefit attached to this. There's an income doubler, it looks like, for long-term care type coverage. It can't replace long-term care, but if you can't qualify for long-term care, this is a good alternative. And they've got some unique index selections where you can choose to juice your returns by paying a little extra in fees. Yeah, I think this is a good product, probably for younger clients is what I'm thinking, because the deferral period can be so long, 15 years of that 200% bonus. That's a long time to get a 200% bonus on your benefit base. So good product from a good company, probably best suited for young people looking for increasing income, or maybe older people who can't qualify for long-term care, using this as a pseudo long-term care type replacement. So hopefully that's been helpful for you. Again, this is the first review in our series of annuity reviews. We'll be going through the entire grid. There's a bunch of products on there. And Brady, you got your work cut out for you because you're bird dogging all these and getting it all ready for us. But hopefully this has been helpful. If you are considering purchasing an annuity and you want to know whether or not it's right for you and in your best interest and is actually going to accomplish the goals that you're hoping it will accomplish for you, I would encourage you to engage us for a discussion. You can do that by going to our website, leveragedwm.com. Up at the top, you'll see book a meeting. You'll see contact us. There's all kinds of ways that you can reach out to us. We try to make it as easy as possible. Most people will start with a really short, easy, kind of no hassle discovery call is what we call them. Brady handles a lot of our discovery calls here in the office. I would say on average there, 15 to 30 minutes.
Yep.
And it's basically just you getting to know the people and talking about their goals and what they're hoping to achieve and figuring out if we can come to some kind of win-win solution. Is that typically how they go?
That's exactly how they go.
Cool. Well, that's the purpose. We're here, we exist because we believe that people should have access to good, sound, straightforward financial advice. It doesn't have to be complicated. We don't like to talk over people. And yet we love to give you the full picture because we believe that you can make a good decision with your money as long as you're armed with the right information. And so that's why we exist. If you're considering an annuity, if you're considering something like a life insurance policy, this is our specialty. This is our wheelhouse. You should absolutely reach out to us. You can do that on our website, leveragedwm.com. You'll see book a meeting at the top, and we look forward to talking with you soon. Take care.